if you're looking to offset your active income with passive income, real estate is probably the most efficient path because you have passive cash flow.
Welcome to A Better Lifestyle. I am your host, Richard, and I will be with you throughout this journey. This show is here to empower individuals to do more in life professionally. You will find a variety of topics that will help you to be more productive and more successful. So join me and the professionals from different industries as we bring education and knowledge for more success.
Hi, everybody. My name is Richard. Welcome to A Better Lifestyle. Today, it's all about real estate, and I have a guest with me. His name is Flint Jamison. I don't know if I'm...
Yep, that's it.
That's it? Okay, Flint Jamison, right?
Flint Jamison. Yep. It's like Flint, Michigan.
All right. So glad to have you. And tell us a little about tell us a little bit about yourself, your background, your professional background, where you're coming from, and take us from the beginning until where you are today.
Yeah. So I'm a mechanical engineer by education and actually by trade. I've been doing aerospace industry for 20 years. And somewhere in the 2018 timeframe, I decided I didn't want to work 9 to 5 my entire life, and I wanted a path to early retirement. And so I did research. I was actually trying to get into stocks, tried to hack stocks, listen to podcasts, try to get smart. But at the end of the day, it feels a lot like gambling to me. And I always had an inkling on real estate. So actually 2018 is when I bought my first duplex. I rehabbed it, got renters in, did a cash out refi. It was good. But I realized the path to early retirement by doing a bunch of duplexes and fourplexes was going to be a very long road. Like I needed to get 50 units or so just based on an average cash flow per door per month. So from there, I discovered multifamily syndications, which is basically buying apartment buildings. But a syndication is basically you get in with a group of investors, you pool your resources, your money together, and there's a general partnership group that does all the sweat equity, find the deal, get a loan on it, manage the asset, and you buy up the property. And it's actually really high returns. And for the investors, it's passive. There's not a whole lot of work. Even though I don't manage my duplex, there's still work, right? I still have to manage the accounting. And when a tree falls over on my fence, which did earlier this year, I still have to deal with all that, right? So with syndications, you can get in totally passive. You don't have to deal with all that. And as I may have said, it's the most efficient path to retirement for me. So that's a brief summary of my history.
Okay. Funny you mentioned about syndication, because I wanted to ask you that I had that in mind. Could you briefly again elaborate what is syndication for some people?
So we'll dial it back a little bit into more detail. So there's two sides to it. Like I said, a bunch of like-minded people get together and pool their resources. Some of those are experts who know how to find a deal, how to purchase an apartment complex, how to run it, right? Those are the general partners. The general partners are doing all of the hard work to make the deal happen. And then we bring in a bunch of what we call limited partners, who are the passive investors. They bring the financial force behind the deal, and they don't have control in the deal. The general partners basically open up an opportunity to investors out there, and then it's typically like a 15% IRR return over a 5-year period. We shoot for doubling your money in 5 years. And then yeah, the investors, if they like the deal, they like the property where it's at, they buy into it and sit back and relax and watch the cash flow. So all the passive investors get equity. This isn't like a REIT where you just dump money into a fund and hope it does okay. This is a true equity position. So here in the US, we get tax incentives from that, right? We depreciate the property, we show a loss on the IRS, which is a tax benefit, and you actually get cash flow. We will either do a monthly or quarterly distribution on cash flows because properties are have rents coming in, right?
Okay. How many people usually get together for the syndication?
Okay, so that's depending on the size of the deal. You can technically syndicate with a very small number of people. I mean, you can go buy $1 million property and bring in 5 of your best friends and syndicate that way. You might have one person who's essentially doing all the sweat equity, right? The person who finds it, gets lending and manages it, and his 4 buddies could just be the passive investors. But I'll give you an example. What we just closed on a few weeks ago was a 100-unit in Augusta, Georgia. That was a $14.5 million deal. We had to bring $4.5 million to the table. It's like we have to bring in the 20% to the purchase, right? Because we do get a loan. We go out and get a private loan or an institutional loan, and then the investors bring in that 20% plus possible CapEx. So what we look to do is a value add. So we force appreciation into the property. We renovate, we bring rents up, we increase the revenue, and that increases the value of the property. So on that particular one, there was probably there's a general partnership that was probably between 10 and 15 people between everybody who had to make that deal happen. And then we could have anywhere between 30 and 50 investors on that. I don't have the numbers off the top of my head, but it's a $50,000 minimum buy-in. So you can have a ton of investors that fill that deal.
Okay. I like the real estate world. That's why I was asking about syndication. I'm not sure. Possibly we have that here in Montreal or in Canada, because you guys are in the US. I never heard that word here in.
Yeah, so the word isn't a formal legal term. Syndication is just a group of people that combine resources to do something that no individual could do by themselves, right? It doesn't have to be purchasing. It could be, I don't know, something completely non-real estate related, right? It's just the definition of syndication. So the one thing that the US does have is our SEC, Securities and Exchange Commission rules, legal rules, and they have allowed for investors to get into these alternative assets. It's basically a private equity investment. And throughout history, this has been kind of known as the wealthy man's game. You got to know who's who to get into it. You got to have a lot of money to get into it. But the SEC has changed the rules to where we as general partners can group together with limited partners and protect everyone legally on multiple bases. So we have accredited investors, right? The SEC defines what an accredited investor is. This is someone with net worth of $1 million or makes $200K a year for the last 2 years. And then if you're below that, if you're not accredited, we can bring in what we call sophisticated investors. And this is where you have to actually develop a relationship with someone like myself. We'll interview you. We'll make sure if you do want to invest $50,000, do you have the level of sophistication to understand what you're getting into? Do we feel that you can take on that risk to put $50,000 into a deal. With any investment, no matter what it is, you have to make the assumption that you could lose the money, right? You never invest money without the assumption that you could lose it. So we say the same thing. Now there's super stable assets, there's high risk assets, right? We like to consider this a high return, stable asset. So yeah, we've had all the investors, and then we can bring you into the deal with all the legal documents that are essentially defined by the SEC.
Okay. If someone wants to start, a beginner wants to start investing in the real estate market, purchasing properties or whatever it is, what do they need to know before they start?
Yeah. If we're talking syndications, well, really real estate's all about educating yourself. You have to educate yourself, right? Even getting into a single family home, you may know the area really well, or you might purchase something out of state like I did. You got to know the economy you're buying into, which city you're going into. If you're getting into a syndication, there's a few things you really got to know. One is you get to interview the general partnership, right? Me and my team, we will present a deal. You contact us directly. If you're investing with us, we've had that interview, we've had that face-to-face. I want to compare this to stocks and mutual funds, right? Your paper assets. You never get to interview the fund manager. You never get to go interview Elon Musk and ask him not to tweet something and make the stock bounce around, right? With us, you truly get to interview us, and we are constantly giving you updates. We'll give you monthly updates for the first 6 months. We'll do quarterly updates after that, right? We're always in contact with our investors. So we, as general partners, have to build a trust with our investors. So one is reach out to us. Two, you got to get educated on a deal. Three, you got to like the economy in that area, right? Augusta, Georgia. One of the things we provide is here's where the property is in Augusta. Here's the surrounding businesses. Here's the type of clientele we're going to pull. Like if there's a hospital, and then we have a Class B unit, we're going to be pulling a bunch of nurses. There's a school nearby. We might have student housing, right? We provide all that. Here's the economic growth of Augusta. Here's here's all the big businesses that are supporting the area. This is we try to always define that it is a very strong economy before we go into it. Otherwise, we're putting everybody at risk, including ourselves. So, but getting into the deal is actually easier than getting into a single family home. Everybody knows what it takes to buy a home, right? And you have to sign 1,000 pieces of paper to buy one. With this, as a limited partner, yes, you have to kind of know the process. We lay that out. We'll tell you the business strategy to get you the returns. But when you invest, all you have to sign is a private placement memorandum. It's about 90 pages. There's a few places in there you sign, you put in your information, wire your money, and you're in. Super simple.
Okay. When I was talking about someone who wants to invest, I was not talking about like investing in you guys' company like directly. I was just referring to let's say someone is in Toronto or Vancouver. They wanna start purchasing properties like to create passive income. What are the things like they need to know before they start? We'll get back to your company after.
No, that's fine. Well, so if you want to talk outside of syndications, or are you talking just like in general, let's go buy a single family home or a condo?
Yeah, or a multi-unit, an apartment building, yeah.
So the easiest always investing in your backyard because you know it the best, right? You know the economy around you. You have a good understanding if it's going to grow. Because if you want a rental property, you need a strong economy. You don't want to go buy a house out in the middle of nowhere, right? You have to have a strong influx of potential tenants, and you want to know what kind of tenants you want to place in there and the salary level, right? What's the average salary level of that city that you hope to buy in? So I think that's one of the critical pieces. Are you buying in a nice area? Or are you buying in we call it a B or a C class, right? What kind of clientele are you looking at? So to give you an example, on my duplex, I actually bought in a lower income area. I bought a very distressed property and I renovated it, right? Brought it up to a more livable level, and I brought in better tenants. They were partially government subsidized, which is kind of cool. One, it gives me stability, especially during COVID. It really helped. But two, I have created, these tenants in particular are handicapped, and we converted the lower unit into handicapped accessible. So I have created a nicer living space for two elderly ladies who are handicapped, and they are partially government subsidized. They are very stable tenants, right? You got to think through all of the things that you're doing. One of the most important things is to take care of your tenants. Don't just buy a place, slap some people in it, and get a property management and forget about it. You want to take care of your tenants, because if you take care of your tenants, they will take care of you. You need to make sure you vet your tenants well. Your property manager can help you with that. I let them do that for me. And then if you decide, like what I'm doing, I put value add into a property. I got some stable tenants in there. I did a cash out refi, so I got some money back. And at some point, there's natural appreciation as well. Now the value of that property is a lot higher, and I can choose to turn around and sell it. So it all depends on the game you want to play. If you just want to buy and hold forever and sit on cash flow, you have to make sure that that property is going to cash flow. Do not buy for appreciation. If you flip a house, sure, you're buying for pure forced appreciation. But if you want to sit on a property for a while, you always have to underwrite to make sure you have cash flow.
Okay. What mistakes do you see people do when they get into real estate investing?
There's so many mistakes. I think we always through life try to get through anything we do without mistakes, but we always make mistakes, right? It's we learn through failure. And I think that the biggest thing is it's not if, it's always when. And you have to be able to adapt to the problems that come, especially the problems you don't see. There's a great example. It's on top of my mind today because another syndication group, these people I know, they had one of their apartments caught on fire. I mean, and this is the second fire I've heard of on an apartment syndication. You plan for it by having insurance, right? That one in particular, you make sure you have really strong insurance. You make sure your property management can act quickly. So what they did is they got all the tenants neighboring that one unit, right? Well, one, it's threat, their apartment might catch on fire. You have to get those tenants out, and you have to place those tenants somewhere. Get them in a hotel, right? You got to be very proactive. Get them in a hotel. Once that, luckily, no one was hurt in their fire, and it was largely contained to one unit. But now you got to be proactive, get a contractor in there. You got to rehab that unit, fix everything, get engineers back in there, make sure it's still structurally sound before you finish renovating it and putting tenants back in, right? It's all these things you got to think through. If there's a flood, same thing. You better have good insurance in place. If you have bad tenants, you got to have a strong property manager in place that knows how to handle bad tenants. There's 100 different ways you can handle tenants and creatively get them out without them, destroying every wall before they go out. So the key here is there's always going to be a failure. I had a tree fall on a fence. It cost me money. I saved up to make sure I have a savings account for the rainy day, right? Yeah, I guess that mostly describes it. We could play the what if games all day long, and I guess everybody has failures at some point, and that's how we get better.
Okay. You're in. I know you do commercial real estate. If let's say I'm just taking for myself. Let's say I want to get into the commercial real estate. What do I need to know? Where do I begin? Like, is it profitable, or how do I proceed?
Are you? Yeah. So there's the two different avenues. There's the general partnership. If you don't have the money to invest, you can technically get in with $0. You end up on the general partnership side. Maybe you're a good deal finder. Maybe you can underwrite. Go partner with a bigger team. Maybe you can capital raise, right? There is a lot of different roles that a general partnership needs, and you can get in on the general partnership side as long as you work for it, right? And then you'll get a piece of the equity as well. From the limited partner, well, for one, you got to educate yourself. I always go back to education. I started on podcasts. I digested podcasts for a better part of a year before I actually took action and started moving forward. There's a ton of books out there. And then, especially for general partners, I highly recommend you getting into a course. There's a bunch of courses, online courses you can take. You can get in with mentorship programs, right? That's how you get into the general partnership side. Now, on the limited partner, all of us, not only just Vestus Capital, but there are a ton of general partners out there looking for investors. So you go to their website, they're probably going to have a ton of data, a ton of information for you to digest. What does it take to get in to be a limited partner? I mean, literally just sign up for their investor club. It's free. You sign up, you put your name in there, they'll give you a call, you'll talk through it. They will help you through it. This is an education game. And actually, to be honest, this is one of the reasons I like it. I really love raising capital because I get to talk to all new people and educate them through this, because most people don't know that this exists, right? This isn't a sales thing. This is more of this is a possibility. Let me tell you how it's a possibility. And there's, right, light bulbs start coming on when they realize, wow, I can own real estate without having to do anything. I just sign some paperwork and wire you money. That's incredible. And we have really good returns, right? We do very conservative underwriting for the 15% IRR returns over 5 years.
Okay. Can you go back to the beginning when you said you could have you could put zero money down and have a general partnership?
Yeah. So the general partner, the limited partner, general partners split on a property is typically like a 70-30 or 80-20, depending on the deal. So we'll talk the 80-20. 80% of the equity goes to the limited partners, and then the remaining 20% goes to the general partnership. And that could be like a team of 3 to 10 people or whatever it ends up being. So if you have some sort of skill set, like you could be an engineer that's really good on calculations and spreadsheets, you go and learn how to do underwriting through some webinar course, you find some partners, you say, start sending me deals, I will underwrite them, right? And there's always an underwriter in the general partnership, someone who is underwriting 100 deals a year, 150 deals a year until that one deal pops, right? You could be on the general partnership by putting a ton of energy into just underwriting. If you're construction management, right? You could have a skill. You could have a skill in managing properties. So you can get in on any piece of this pie if you get with a partnership that's letting you get in just doing the sweat equity work. Does that make sense?
Yeah, because when you said like the no money down, it kind of caught my attention because
Yeah.
I was gonna get into the capital situation. People want to invest in real estate, but the amount to invest is a lot for the average person. So that's why sometimes it stops a lot of people from investing into real estate because you have to put like 20% down of this and that and
Yep.
so
Yeah. There, if you think about it, there's a lot of people who have at least $50,000 invested somewhere, right? It could be in a 401k or an IRA. I get you're in Canada and there could be different forms of retirement funds. You can actually invest your retirement funds into a syndication. Or you might just have $50,000 in some stocks and mutual funds. You can pull that and drop that into real estate. So you'd be surprised how many people, if you just look at their accounts, have a money to put in or more, right? We get some really big investors, but we like to say 50K can get the average middle class person into a deal versus a single family home. You're right. It's hard to buy a single family home for 50K.
okay, well, here in Montreal you won't find that.
Yeah.
You won't find that, but you said 50K.
$50,000 is usually our minimum investment.
Okay, yeah. You mean for down payment or?
No. This is just for an investor, right? So we take.
Oh, okay.
We combine everybody's money together to create the
Okay.
down payment, and on top of that, we also raise capital expenditures so we can do renovations as well.
Okay, it's my mistake. I thought like yeah. Okay, so it's 50,000. Okay, the investor puts in.
Yep.
Okay, the investment. Okay. Um, what benefits? I was saying if it was profitable before commercial real estate. Uh, some people think that there's not that much money to be made in commercial real estate, or whether it's commercial or residential. Is it really profitable? Can someone really make money with these kind of investments?
Absolutely. Yeah, I don't know of another investment path where you can double your money in 5 years unless you get lucky on a stock, right? Or you get lucky in crypto. But by buying a single family home or a duplex, people have been able to pull it off. It's just harder to get there, and you're less likely to get those type of returns that quickly. The cool thing about commercial real estate is it is valued by the net operating income. So if you can increase the revenue, decrease expenses, all of a sudden the value of the property goes up because it is a revenue generating machine. So the value is based on how much revenue it makes. Single family homes are based on what your neighbor sold for, right? So you could take a home and flip it, but if your neighbor sold for super cheap, you may have just lost a bunch of money because you pumped a bunch in to flip it, but the neighbor sold for cheap. Now that house is devalued. With what we do, we renovate, we get rents up, we decrease expenses. All of a sudden, the price or the value of that property skyrockets, and we can calculate it. That's what's fun is we actually have a business strategy that we can fully calculate how we can get returns. And that's actually what excites me over the paper assets, right? Because paper assets, you can look at a bunch of PE ratios and if you can read the pro forma from the company and understand it, right? It's just you can't really build a plan around it. You're investing on hope that this company is going to continue growing when you're putting money into a stock. versus what we do right now. There's asset classes. Let me dive deeper into the commercial assets. In the past 5 years, now I'm going by memory because I was just at an economics talk. In the past 5 years, self-storage has actually outperformed all of them, which is pretty cool. And close second is multifamily. I like multifamily because you're investing in a basic human need. Everybody needs shelter, right? No matter what the economy is doing, up or down, people are still going to need a place to live. Retail, that's a funny one. The Economist was just saying retail is on its way back, but as we saw through COVID, or even before that, shopping malls are not doing so healthy. People are shopping online, but COVID also hit the office. We found alternates to office space where people are now working from home. Oddly enough, apparently that's on the return. That's going to be on the rise. So if you're interested in buying office buildings, syndicating office buildings, you may be in for a treat, according to the Economist I listened to. There's another asset, industrial, right? Buying big warehouses and stuff. Those are doing fairly well. But really the only two I know the best is self-storage and multifamily.
Okay. What have you learned so far from the time you've been investing in the real estate market? What have you learned?
Oh, that's a big question. I've learned a lot, actually. So the thing that has surprised. Go ahead.
And just forgive me for cutting it off. And what have you learned, and what advice could you give for future investors?
So I think the biggest surprise I had when I learned, like I said, there was failures along the way. You fail forward, you get smarter, and you move on. That's the key. One is you always move forward because that's the path to success. But the biggest surprise I've had is the impact on people's lives that we have. You're buying a apartment building that's likely mismanaged. What we do, we buy mismanaged property, underperforming properties, aged properties that are tired, have a lot of deferred maintenance, right? The residents are living in a place that it could be falling apart or isn't nice. We will go in there and totally renovate the place. We'll put in a playground for the kids. We'll put in a little dog run for dogs, improve the property, put a paint job on the outside, renovate all the units, maybe put hard surfaces in, some nice planked laminate flooring. Just make it a nice living space, right? Everybody wants to live somewhere nice. And typically what comes with underperforming assets and distressed assets is you might have tenants in there that are likely and maybe more into crime, right? Especially if you get into C-class properties, very distressed properties. We have displaced bad tenants to the point where the chief of police has noticed and asked us to buy up the rest of the block because that upgrading that property made a blip in a positive direction in the crime rate in the area. So we put up fences all around the property. We'll put security cameras, right? Make it feel safe for families. So, and then we create a community around it. We get tenants all the time just thanking us for what we've done, and it makes us feel good. So we have two priorities. One is protect the investors, and two is make the tenants happy.
Vestus Capital, can you give us an overview of? I went on the website and I saw a lot of things. can you just give an overview of what you guys do, the services you offer, and what can we expect from?
Yeah. So Vestus Capital, I partner with other syndication teams because this is a team sport. Just recently on this 100 unit, I teamed with another larger team, and we partnered up to close the deal. I take investors all the time. I'm constantly partnering with these experienced groups. So really what I do is I provide the avenue and educate investors for investors to get into a deal like this.
Okay. Is it only in the US? If someone is in Canada, can Canadians do business with you guys?
Yes. Yes. And I'm not smart on that yet. I actually know several Canadians who are in the space. Some of them are actual general partners as active players, but live in Canada. So there is a way to do it. Unfortunately, I can't tell you how. My guess is it's harder for the limited partner because you are going to have to convert the funds to US dollar. And then as you earn money in dollars, I'm not sure how you convert them back to Canadian and what the income and tax implications are for that.
Okay. But your role in Vestus Capital, you're not alone. You have partners, right?
Yep.
Okay.
Well, so Vestus Capital at the moment is just me, but when I partner with a bunch of people, it's a lot of people start with their own brand. We partner together. Some teams, like the company that I partnered with, has 5 people working for that company, but they brought in a bunch of others like myself who have our own, facing brand there. Vestus Capital being my brand.
Okay. And if people want to have more information about you and what you do and the company, where can people find you?
Yeah, you can find me just straight at vestuscapital.com. That's VESTUS capital.com. I'm very active on LinkedIn. So if you just want to go to LinkedIn and look up Flint Jamison, you'll find me right there.
Okay. Any final words you'd like to say concerning real estate investing?
Yeah, sure. If you're looking to offset your active income with passive income, real estate is probably the most efficient path because you have passive cash flow. And one thing I like to tell a lot of people, especially in the US, we save money in retirement accounts till the age of 60, 65, hoping that nest egg is large enough to last us till the end of time. If you convert your savings into these passive cash flow assets, you don't need a massive nest egg to retire. All you need is enough passive income to offset your expenses. And then you get to choose when you want to retire.
Okay. Thanks, Flint, for your time and these information. I hope everybody got value out of that. And thank you, everybody, for listening. So this was on real estate, and we'll see you next time. I hope once again everybody found value. Thank you, Flint, for your time.
Thanks, Richard.
No problem. And everybody will see you on the next episode of Welcome to a Better Lifestyle. My name is Richard, and we'll see you next time. Thank you, Flint.
Thanks. Thank you.
Okay. Bye, everybody.